You're listening to the Cash Flow Academy podcast with Andy Tanner, your source for investing made easy. Here's Andy Tanner.
Welcome to the Cash Flow Academy podcast, where investing's made easy. I'm your host, Andy Tanner. Way excited for the show we have on deck. Amazing guest, very important topic, because we're going to be speaking about the uncertainty, how to shield ourselves against uncertainty, and particularly, we're going to do a little study and review of the March of 2020. The market loses a third of its value. Things are going crazy. Very emotional time. We'll talk about how professional traders handle those types of environments. Very, very timely discussion, I believe, for what could be coming on. But we have Alex Gurevich, and he is the author of a best-selling book, The Trades of March 2020, A Shield Against Uncertainty. It's on the Wall Street Journal bestseller list. And so this is one to add to your library, and we'll get a chance to learn more about Alex. But first of all, Alex Gurevich, thank you for being on the program today. We're excited to have you with us.
Andy, thank you very much for having me on. I am looking forward to it.
So your background, you've been on Wall Street for a number of years, and one of the exciting things I get to do on the podcast is I always get to talk to people smarter than I am. We'll start with your resume that you received your PhD in mathematics from the University of Chicago. That's a little too much smarter than me. That's intimidating, so I hope I can keep up with you. But you've had quite a career. You're the founder and CIO of Honte Advisors, LLC, and you've been around trading for, as I said, a couple of decades, various roles on Wall Street. You've traded fixed income derivatives, macro book at JP Morgan, and on and on and on. You're also the author of The Perfect Trade, which was published in 2015. So quite a resume. But let's start here. What made you think about, what brought a little bit of your background and bring us up to the point where you decided to write this particular book? I mean, I knew you grew up in St. Petersburg, correct?
Correct. Well, that's a long path. As you've mentioned, I'm not a spring chicken anymore, unfortunately. So this is quarter of a century in the markets, and obviously I did some things before that in my life, so it's a long path from St. Petersburg to writing this book. But in a very weird way, this path was somewhat predestined for me, or at least more likely than one would imagine, because I had a dream of coming to America and becoming a Wall Street trader since I was quite young.
Wow.
Since I was a teenager. And I remember watching the movie Wall Street back in Russia in the 80s, and I was so obsessed with it. I remember the excitement. I remember the adrenaline I felt from seeing the trading floor on TV, and I just really felt that this was for me. Which is interesting because I was always a very analytic person. I also always, since I was 4 years old, was talking about being a mathematician. That was always a natural path for me. But I always loved games and strategy and competitions. I did a lot of academic competitions on many different subjects. And what was interesting about me, I was never really the absolutely first in anything. I was always good, but I was not
interesting
breaking absolute records on any one single thing. What I was very versatile. Same thing with games. I learned to play really well, really many games. Hence, the term Honte, it means true move.
Oh, okay.
So strategically a long horizon move, which comes from the game Go, which is a very old Japanese and Chinese game that probably the game I spend most of my time in my life on. But I played chess, of course. I played poker, a lot of serious poker, or many other strategic resource management games. So for me, strategy was a very big part of my psyche and my upbringing. So when you combine analytics and strategy, you basically get Wall Street if you choose to. It was very natural for me once I did do my math path and I got my PhD and I kind of proved my mettle in mathematics. It was very natural for me to think of trying to do something different and going into finance.
Interesting about, the adrenaline, because generally this is really good because, I was a basketball player. I'm a very emotional person, and trying to get a hold of my emotions early in my investing, that was the biggest thing. is because it's an extremely emotional market. And as any technical analyst will tell you, you're watching emotions go up and down. And we certainly had some big ones in 2020.
Yes, definitely. And that which leads me to the book idea. Like over time, as I developed my strategies working on Wall Street, which was originally was Bankers Trust, which became Deutsche Bank after the merger. And then, as you mentioned, I did many different roles on Wall Street, but it was a broad background that I built. And then when I went to Chase, which became JP Morgan Chase, so I've developed my strategies. I started to articulate them more and more. And then I wrote my first book talking about my strategies kind of in a qualitative way, discussing how do I select trades? How do I ex ante know what is a good trade without actually trying to know what happens in the future? And this is why I distinguish strategy and analysis. Analysis is about trying to calculate the solution.
Mm-hmm.
Like when economists analyze the market and they come up, we forecast GDP 0.3%, right?
Yeah.
That's a one number. That's not strategy. Sometimes even that is the forecast, but risks to portfolio and how you can manage the portfolio is very different. And sometimes you just don't know what's going to happen. You just need to decide how you're going to respond to things when they're happening. And very often people ask me, what if this happens? I was like, I don't know. When it happens, I'll figure out what to do.
Well, I first of all, I think people have a misconception that people on Wall Street have a special gift or a crystal ball of knowing what's going to happen. And I would say that when I look at investing or trading, either way, you have an analytics phase, whether that's in fundamentals, technicals, a quantitative strategy, and then you have your execution of how you position yourself. How do you want to position yourself to benefit? And then you have your risk management, which is really the biggest part of it, I think, is an ability to react and an ability to respond because there's so many unknowns. Let's talk about, I like the idea you said, GDP is just one number. When we look at the pandemic crash, there was a lot of things that I think may have gone into that other than just a pandemic, particularly when you look at the Federal Reserve and their posture. They had tried to start raising rates prior to that, almost as if they were reloading their toolbox or reloading their magazine to have some ammunition. And in the fall of 2019, it almost seems as if, as you look at their balance sheet and how it began to expand again, that they had gone to this idea of, maybe we are going to try to keep interest rates, lower for a long time. Maybe we're going to have this easing really in a period that I didn't know if it justified the easing. Did we have a bit of a bubble even before the pandemic, and did the pandemic just give us an excuse to let it out? I mean, what would you say about the environment pre-pandemic?
Well, this is a very good question because it's very aligned with how I structured my book and how I was thinking about this. Because so I became very acclaimed for my interest rate trades in the year 2020 and betting on lower rates. Mm-hmm. And there was a lot of there was some publicity around that because I had an interview with John Burbank back in 2019. Then we discussed our trades, how we were betting with deep out of the money calls on Eurodollar futures. For people who are not familiar with the instrument, it's just basically betting in a very leveraged way that rates will go to zero.
Right.
And that bet, I established that bet back in 2018 when I was convinced that we're in the late cycle. So when I decided to write a book about the beginning of pandemic crisis, the trades of March 2020, I started it with trying to capture the zeitgeist before it, where I was at, what was bothering me, like when I was having, what was good, what was bad for me. Because if you go in some event, like you go into a party, you want to maybe describe how you dressed for the party, right?
Mm-hmm. Yeah.
Are you already drunk or you're sober, right? Are you in a tuxedo or in a t-shirt, right? So it's so I'm going into the crisis. What was happening to my portfolio, right? Where you're at. And I was really talking about importance of where you're at before events happen. Because I compared it to being a poker player. When you're already winning, when you're up on the night, it's much easier to make good decisions.
Yeah.
Because you can just really relax your brain. And if you're already stuck, as poker players say, which means losing money, it's much harder to do correct decisions. So in that way, it was fortunate for me that I was already positioning for lower interest rates. I saw in 2018 when everyone was talking about raising rates, I I wrote this piece for my investors discussing like 16 different signs that we're in a late cycle. I was overwhelmingly convinced that cycle is rolling over in 2018. And I basically completely committed to that bet as much as I could within risk management parameters. And then 2019 was a good year for me completely before the pandemic. So I started the year with a good momentum. I think rates would have eventually gotten to zero, pandemic or no pandemic. It was kind of whatever shoe dropped. What I realized that whatever happened, rates would go to zero. And something always happens, and the momentum was in a direction anyway. What is very difficult to say how it would play out without pandemic. There is a little discussion in my book about that too, because what we do know is the economic numbers which were coming in March and April 2020, which were a little lagging and referring to events before the beginning of pandemic. So we have a little bit of that lagging information, and it was actually economic numbers were not so bad. However, I think one way or another rates would have gotten to zero. That remains to be my view, but as I like to say, history is not an experimental science. You cannot just say rewind, take away the pandemic, let's see how that works. There's just no way to know. It's very similar in that way to September 11th, because I think for people who have not been in 2001, have not traded in 2001, very often people say like, oh, there was September 11th and then a recession. That's actually not true at all. The recession was really gaining momentum way before that. Nasdaq crushed in
gave it a reason.
2000, and there were already very vigorous interest rate cutting going on in 2001, and a lot of us thought that if anything, September 11th made recovery sharper because like the stimulus just came in so sharp in the end of 2021, and the recession was actually relatively shallow in the end, even though the inflation was really low for a while and there was no like pressure to raise rates for a while, like the way they're feeling today, which is a completely separate conversation. But it is really hard to say what kind of recession we would have had without September 11th. I actually think it would have been as deep, if not worse, and rates would have still gone very low. And same thing, it's not exactly the same thing, I think, with COVID, but there are some similarities in this thinking.
Let's talk a little bit about the difference. I enjoy speaking to both what is, people consider the investor, the person who looks more at having a company and wanting to collect the dividend. And then there's the trader who is going to do his best, particularly in the options market. We're going to try to use time decay and volatility to our advantage as well as price movement. The pandemic for me was kind of an exciting time because I'm not smart enough to be a quant trader, but I do enjoy some fundamental and technical analysis. And from a fundamental standpoint, whenever there's a crash like this, I feel like it's a sale. And I start selling puts out of the money to see, I find my dream stock at a dream price, and then I sell a few puts even better to give it a better price and see if I can't get paid to pick up just a steal, just a killer bargain on something I want to hold a long, long time. That's pretty easy to do. If you have some cash on the side, and even if you can't pick a bottom very well, if you can find a good fundamental reason for a stock you think will be around for 20 years and pays a good dividend. I picked up like some examples, some ExxonMobil. I picked up some airline stocks pretty cheap. I felt a little nervous because Buffett was selling his, but I thought, no, I'm going to pick up some Delta Airlines. That's pretty easy to do in a crash. What's really tough to do, I think, is to protect what you already have if you care more about stock price than dividend. For a guy like me, I'm content to sell puts, sell out of the money calls, cash flow with a dividend on some stocks. Give me an offer I can't refuse. Okay, I'll give up my stock for a little while. Give me a sale I can't refuse. Great, I'll take some premium to promise to buy something cheap. But for the trader, I think your subtitle is fantastic. Again, the book is The Trades of March 2020, a shield against the uncertainty. So, take me in the war room because you guys manage a lot of money, and it's not just that's the other thing. When I manage my money, there's stress, for my money. But if I was managing someone else's, oh my gosh, that's a whole different deal. Take me a little bit in the war room. You talked about the build up to it, what you thought interest rates would be. Now we have a pandemic and the market is really sliding faster in March. That 1/3 haircut, that's the fastest slide I've ever seen. How did this happen? And take me in the war room. What was going on there in terms of protection?
Certainly. Well, first thing, I want to just respond to something that you said earlier, the difference between traders and investors. I think sometimes think of that as this difference in terms of time horizon.
Yes.
But I think about it more like you do in terms of actually kind of objective in what you're doing. Investors, so people kind of statically hold certain portfolio. They have a portfolio of stocks or real estate, whatever, and they just hold it. And what I call it, they submit to whatever market does. If market is down, they're down. If market is up, they're up.
Yeah.
Like that's how people usually talk. You talk to people and they say like, oh, damn, market is down. I'm losing money, right? I call it submitting to the market, which is not necessarily a bad thing because market goes up, stock market goes up more often than down. And maybe all you have to do is not to screw it up. If it's your retirement account, if you don't need the money, you can just hold it for 30 years, 40 years, and eventually tends to make money. There is nothing wrong with this. Now, traders could have very different horizons. For example, you described one strategy that you do. I do very different things. I tend to be a long horizon trader. A lot of my trades can last for several years. A lot of my themes, even if I might adjust the actual positioning, but the theme, like say long dollar or short dollar or long bonds, could be a very long-term theme. But I'm still a trader. What I like to say is like my job is still to buy low and sell high. A little bit to what you're saying. The objective is to not to hold some index and perform as this index or a little better, a little worse. My job is to buy things which are cheap and sell things which are expensive. And one of the objectives of a global macro trader like myself, because I'm not beholden to owning a portfolio of stocks, I try to provide some diversification for my investors who have other beta-like investments. So beta investments which are positively correlated to stock market. It's not just stocks. It's your startup investments, your real estate, anything else, any assets that you own, right? So most people have a lot of assets, say if you're a family office, right? But global macro can do something different, which is, it does not mean that you just own puts on stock market. It's going back to your protection and just make money only when stock market goes down. There are funds that do that. That's not what I do. I try to do the best I can in any environment, but what I try to do do it in such a way that my performance is not consistently correlated to stock market.
Right.
Which means that I cannot of course guarantee anything, but I tend to do on average better than stock market when stock market is down. And I could even be up money on the years when stock market is down, and thus providing really good diversification for portfolios where it fits right. So that's the objective. And that goes back to how do you do that and what do you do when stock market plunges. And the best thing to do is to have right positions in place in advance. There is this Russian saying, which roughly can be translated that a victory is forged behind the lines. Mm-hmm. So the victory is in preparation.
I think that's an interesting thing for people, going beyond just the idea of puts. But I think a lot of new investors or new traders really think about having to rely on prognostication of markets, whether it's a precious metals or real estate or bonds or whatever instrument, currencies. But the idea of insurance is something people should understand, is that, hey, I have insurance on my car, some type of hedge. I have insurance on my home, not maybe necessarily believing or predicting that would burn down, but more of an attitude of preparation in case it does. I have a position in my place. Very difficult to sell a house when it's burning. I guess you could say, hey, fire sale, hurry up, it's going fast, but it's not going to work. But if you have an alternate position, such as an insurance policy, well, then if your house does set on fire, well, it makes you look like a genius if you were a stock trader and you had positions in place that were preparatory for something like this. Is that close to what you're saying?
Yes, and that leads to the struggle of many portfolio managers, I won't say all portfolio managers. And the struggle always the trade-off that if you pay for your insurance, you underperform on bad years. And then like you keep saying like, oh, the market is up 10%, but I am up only 8% because I paid 2% for insurance.
Right.
Next year, the market is 10%, and I'm up only 7% because I paid for insurance. And how much pain are you willing to take paying for this insurance in terms of either reducing your positions when market goes against you, or buying puts, or having some kind of strategy that insures you? I think there is a consensus that there is a cost to that.
Yeah.
What I've tried to break back in the year 2002, which is now 20 years ago, me, along with some people who did it even before me, probably people like Cliff Asness or Ray Dalio, but I was doing it independently at JP Morgan, the idea that you actually know you can get insurance and actually be paid money for the insurance.
Mm-hmm.
And that was the origin of the idea known as risk parity. So I did a risk parity presentation internally in JP Morgan. I had no idea about what other people were doing and what was, I never knew even the term risk parity, but the idea is that you have a portfolio of stock futures or stocks and you overlay it with being long interest rate markets, mm-hmm. which is betting on interest rates to go down. When you're long bonds, and you don't, for a leveraged portfolio, this is a very important concept. You don't shift money from stocks into bonds. You don't go from 100% stocks to 60-40. That's how most individual investors have to think, and then they give up they reduce volatility, but give up some of the performance. Obviously, 60-40 portfolio was a great performer. But the idea for leveraged portfolios of risk parity was, no, we keep 100% stocks and overlay it with bond futures, which on average also make money. But the great thing about that was whenever stocks went down, it would usually happen in a recessionary environment, Fed would cut rates, you make money on the other position, and you keep making money on one or the other. I'm detailing it a little more. Some people may know well about it, but for new traders, it could be interesting thing to know. Now, I honestly think, I'm not, as I said, I'm not the first inventor of it, but I think risk parity was as important idea to financial markets as theory of relativity for physics.
That's quite a comparison, but I'd have to agree. Most people don't carry the leverage that some hedge funds do, right? They don't. That's a higher game than they play. When you wrote the book Traders of March 2020. What are the lessons that people can find in that book? What are the 2 or 3 lessons you would hope someone would glean from the book you've written?
Well, one of the principles that I try to focus on this book and kind of see how it played out, sometimes you face the environments of great uncertainty. Like you really don't know what's going to happen next, like the pandemic crisis. Like you could be amateur epidemiologist all you want to, but the reality is that you just really don't know what's going to happen.
Right.
And plus, you don't even if you know what's going to happen with the virus, you don't know what's going to happen with the market, what's going to happen with the policy response. There is too many uncertainties. In the uncertain environments, what I try to say, don't try to resolve them. Don't try to find a solution. That's what's going to happen, because likely you'll be wrong anyway.
Yeah.
Try to focus on if there are any certain likelihoods in this environment. Like, for example, if you're in the middle of pandemic, what is likely? Well, likely that 3 years from now, one way or another will be on the other side of it. What is also likely when you're in pandemic? Well, likely that the government and both the fiscal policy and the monetary policy will respond to it in a very compassionate way.
Yeah.
It just really, government has no choice. It cannot do otherwise than to add liquidity and support people. And what are the implications of that? Liquidity coming into the markets. And what I said very early, I tweeted actually early in the pandemic will pass, liquidity will stay. And I kept repeating it as a mantra during that spring of 2020. One way or another, the pandemic will pass, but the liquidity that they created during the pandemic will stay. And now we're seeing this liquidity sloshing around, right? It's being taken out now, but it sloshed around a bit in the last couple of years. So one of the interesting counterintuitive lessons to the traders, which I talked about, is when people feel very uncertain environment, they start feeling that they have to be tactical and trade very short term, because they I can only trade today for today and close my positions because I don't know what's going to happen tomorrow.
Yeah.
I find this is, while normally I never tell people whether they should trade long horizon or short horizon. Everything is valid. Anything that makes money is valid. You can trade every second or every 10 years. If you're making money, you're good. It's very important to understand there is no bad, wrong ways to trade. But this one concept I usually push on is that in the times of extreme uncertainty, it's better to actually trade long term, because you don't know what's going to happen tomorrow. And honestly, you don't know what's going to happen in the next hour. And when markets jumping, like they were jumping in March 2020, being short-term offered no protection. Things would gap in such catastrophic ways that you might not be able to execute your stops anyway. You don't know what news are going to come out next 10 minutes. There was really no protection in being tactical. However, protection against uncertainty was in managing the trade so that they're not big enough to destroy your portfolio, go against you, and picking out things that will, one way or another, will have to work over the long horizon.
The position sizing is a huge thing, particularly if you're going to be in a leveraged position. And I think new traders that have blown up their account, they learn that they learn that lesson in an unfortunate way, a very painful way. And I think the reason this is such an important book to read is, as you said, the past doesn't always predict the future, but I look at the environment. People often say, Andy, what are the storm clouds you see? I go, well, the one that scares me the most is the one I've never thought of before. I think your point, I want to drive it home. If people listen carefully, you're never going to get to the point where you think you can see everything or you're going to be wrong. You have to prepare for the thing you can't see. And I like the idea of a long-term horizon, particularly for this reason. Let's talk about the Federal Reserve for a minute, because I think the amount of liquidity that's put in, $4 trillion in a year, tremendous growth. I mean, unprecedented growth in the financial, in the balance sheet of the Federal Reserve. And this last statement from Chairman Powell, I don't know how you heard it, but I heard it. Well, we know our balance sheet's too big. We know interest rates have to go up, and we know we can't keep easing. We know we have to do something. We'll continue to do all of those things, though, as we monitor the situation, knowing we have to do something. So I do think they'll change quickly, but I think there's so much deflationary pressure in the environment, tremendous deflationary pressure that they fought against. That don't they have a very, very delicate dial at this point, meaning that the slightest turning of any of their dials could cause some big swings in the market that would be very tough to manage in the short term. What are your thoughts on that idea?
Well, they definitely don't have an easy job at this point. And it is interesting that you said about a sensitive dial. Somebody pointed out to me a while ago that the larger is the size of global debt, the more sensitive it becomes to the smallest change in interest rates.
Yeah.
So what used to be you needed to raise rates by 2% to tighten financial conditions. Now it could be 0.25% because the total amount of debt service is so large in the economy.
Yeah.
The balance sheets expanded so much overall that the sensitivity of the economy to interest rates or what the Fed does might have increased. So, and they're in a delicate position because they really honestly, they don't know anything now that they didn't know a year ago.
That's
a year
right.
ago, they were very confident that that this inflation would be transitory inflation pressures. They were saying that they would be patient. Now, all of a sudden, they got impatient, even though exactly what they predicted is happening, the short-term inflation pressures. And now there are two camps, some of them arguing that this inflation is pernicious and spiraling, and another camp, which kind of the camp I more belong to, argues that this whole inflationary episode, it's already in the rearview mirror. I think inflation is something that already has not happened. Like it has happened, it's behind us. And we're going into the new world, and the market is again beginning to exhibit signs of late cycle. Mm-hmm. I mean, you don't have stocks plunge 30% on one bad earning report when the cycle is okay.
That's right.
That's another thing.
That's another interest.
Obviously, this is a hint to people on which day we are recording this podcast. We are in a funky environment. It's very hard to judge what's going to happen. And it's going back to my thing. You just have to have a strategy. You have to a little bit release your brain from clinging to the idea there is a huge inflation pressure or no, there is no inflation pressure. You're just going to have to see what's going to unfold.
It will be interesting it's a fun movie to grab your popcorn and watch. As I look at the Fed, I think it's been interesting that it's a lot like the Wizards of Oz, where they have several levers behind the curtain, and when they pull one lever, it seems like they always have to pull another one to offset the damage they did by, the more they try to control it, the more they seem to lose control. Particularly the repo market has been interesting because member banks, well, you have a federal funds rate for member banks that creates competition that can keep an interest rate a floor in it. But for the non-member banks, international banks, money markets, they've really provided liquidity in the reverse repo market to try to establish floors of rates to keep them from going negative there. So I see all these levers and all these dials. If you're going to write a book, the Trades of March, to shield against uncertainty, can this happen again? I mean, could we see the S&P fall to the same levels pre-pandemic? I mean, it's hard for me to think that the GDP in the world is that much different, other than just liquidity put in by the Fed. I don't see that our production is that much different to be where we're at. And from an earnings standpoint, stocks are expensive. From an earnings standpoint, I mean, I think the Schiller's probably close to closing in on 40 pretty quick.
Well, let me argue both sides for you.
Thank you.
As always do, just to give you a little more uncertainty.
Yeah.
Again, addressing from the last thing you said about valuations, I'm not actually an expert on stock valuations in the sense that I don't look at them all that much on overall valuation of stock market. Mm-hmm. I think valuation is kind of a made-up thing. It's basically just a historical, like sometimes when people say like, oh, this stock has to fall, right, it has to trade cheaper, because it's based on historical comparison to the same stock.
True.
Now, if something happened and those historicals no longer work, there is no rule that says that P should be 20 or 30 or 40 or whatever.
Yeah.
If the company, you could argue that, well, if the company has negative cash flows perpetually, eventually it has to go down one way or another, right?
Well,
but if the company has, even that is kind of questionable because it keeps raising capital at high and high valuations. This is, I think, going back to the alchemy of finance by George Soros. You could keep pyramiding almost indefinitely, but you could make an argument, negative cash flows eventually have to bring you down. Let's just put a pin in it. But as long as the company has positive cash flow, there is no actual mechanism by which company has to become cheaper, except some people agreeing to sell it and other people not wanting to buy it. Very often when people ask me, why is the market down to this? I just say, like, more sellers than buyers. What do you want from me, right?
Yeah, that's...
So, and that is, the mechanism is, and there are a lot of people who analyze those mechanisms, like the pension fund flows, the 401ks, all those things, like how they create those inflows and outflows on stock markets.
Yeah.
I'm not an expert on that, but I'm just saying that you can think about this, or you could just say, look, I don't know. However, I observed over my quarter of a century in the markets is that usually when stock market does really well and it goes up and it goes to the money highs and it breaks new levels, it always goes further than people think up. Like even when it seems expensive, it usually goes a bit further. However, there is always a chance to buy it later cheaper.
Mm-hmm.
In fact, as I've been talking about preparedness, in 2018, like in the years like 2017, 2018, I made a poll several times talking at different conventions or whatever. Hey, raise your hands if you think you're going to be able to buy the market cheaper in the next few years. And actually, most people thought they could.
Interesting.
And I was like, well, then why would you be so long the market if you know that in the next 5 years you're going to buy it cheaper? And it did give us not one, but two opportunities. One in the end of 2018 to buy it cheaper, and another in March 2020. And now, one of the things that I think trips up a lot of people, you mentioned it is an easy part to buy cheap, but to buy when it's a crisis. But I don't think it's easy for all people. A lot of people manage to convince themselves that things are really bad and there are reasons for market to go even further down, and they manage to talk themselves out to buy the market. And I think a lot of my career success was basically based on the fact that I've done those things when market needed to be bought most of the times. And like when I might have been positioned for negative beta that is benefiting from market to go down, but when March 2020 came, I started to buy assets, and I did the same thing in March 2009. I was buying assets back then too. And what helps you to do it is to work on preset levels. Just decide, it does not matter why it gets there, but this is my buy level.
And this is one of the reasons I'm grateful to have, people who are A, smarter than me, and B, that are willing to write books and share their experience. I think living in the information age, which is sometimes the misinformation age, but by and large, I think that traders and investors today have more opportunities to get smarter than they ever have. And I think they need that. Could you speak to on the moment, and as an education advocate, I often ask this question: where does the role of financial education come into a trader as opposed to advice? Many people go to Wall Street, and really that's your wheelhouse is, hey, we're going to take control of some of your money. We'll be a custodian of it. We're going to charge you for our expertise. If a person wants to read your book, is it better for them to just say, well, this is too hard for me. I'm not I don't understand quant trading. I'll just pay a fee? Or is there room for the person who says, I would like to study and learn a little bit more about this and take a more active role? Where's the role of financial education as opposed to advice, or do they coexist? What are your thoughts there?
First, again, answer to your last sentence, they do coexist. I think if you're going to start some endeavor like managing your own money, first you need to know ideally what it's really like. And in some sense, that's why I really think where my book stands out, I made this comparison. It's like for a medical student to be in the operating room.
Mm-hmm.
Most other books about trading, they present even my first book, they all present certain perspective.
Yeah.
It's like somebody telling they might be telling their reminiscences, their ideas, and it's colored by that person's ideas and biases. What I did in the trades of March 2020, because I put in the midst of the book all the live transcripts of our trading chatter and all the trades that are actually done, and I'm commenting on them as they go, people can see without any cherry picking what is really happening.
Yeah.
And I think reading this book, aspiring traders, so people who aspire to manage money can actually have a better idea, is it for me or not? You don't need to even understand the terminology. You can just kind of blah, 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 all those names of contracts. It does not matter. You can understand things like, we don't have enough cash, or like, what do we do now, right?
Yeah.
Oh, damn, we just did this trade and it doesn't work out, we have to unwind it, right? People will understand that. You don't need to have any financial education for that. So, and I think the book works that way. So far, I'm getting like good feedback that it does work that way, that you can follow the ideas of it, even if you don't know exactly all the names of the contracts mentioned in that book. I try to explain them for people who are really interested in finance, but I also try to structure it that it's a good introduction for people who just want to know what it's like. Now, there are a lot of aspects of psychological makeup that you probably benefit from by being a trader. To be a trader, to manage your own money, you want to have certain psychological attributes.
For sure.
I think there is no one psychological makeup. There is no one type. This type of person is cut to be a trader. I saw very different people with very different personalities successful on the trading floor. But there are certain aspects of that. And one of them is, I think, you have to be able to kind of, while acknowledging your mistakes, put them behind you.
Mm-hmm.
If you're kind of person who is too much caught up in would-have, should-have, because you're going to miss so much and you're going to make so many mistakes.
Yeah.
If that stresses you too much, if like every trade that you, like, damn, I should have bought it yesterday. Why didn't I buy it yesterday? It was such an obvious thing.
Well, and
it's one thing to like file it and say, okay, this is the signal that I will be looking for in the future, right? And another thing to keep beating yourself up over it.
Yeah,
the inclination is going to be very hard.
I think you've hit upon a good thing. I think people have a misconception that some people are just cut out to do this. And I don't know if your journey was like mine. Maybe there's a few virtuosos or prodigies that just, started out young and know how to do it. But for me, I think people would be surprised that entrepreneurship and investing, trading, whatever financial, pursuit you make, it's an exercise in personal development of not only knowledge, but temperament. I look at the mistakes I've made, and they've basically been in those two camps. Either I was messing around with something I didn't understand real well yet, or I knew it pretty well, but I didn't have my temperament under control. But I think people, you agree, people would be surprised that, hey, this is a wonderful adventure in personal development of being able to pick yourself up, try again, not dwell on the past, discipline in moments of choice?
Definitely. It's that development. And for me, it is also, I think it is very important to learn what trading styles suits your personality.
Yes.
It's kind of, you're working through two sides. You want to teach yourself certain disciplines and certain ways how to relax, how to take your mind off things when you have losses, how to gain perspective. But at the same time, you're still going to be you to an extent, right?
Yeah,
so
there's
people, for example, yeah, go ahead.
Well, I was going to say there's an illusion, I think, that people think there's a recipe, that trading is like, on the back of the package of cookies, there's a recipe on how to bake the cookies. And what I've found in the many interviews I've done is that everyone really does. There's not the market's so dynamic that there's not really a recipe that you could follow, but people do find their own system and their own niche. It's their consistency in what they do, maybe not the secret sauce. Everyone has their thing they do, and they find a rhythm, and they get good at that, and they stick with that. I think you find that across the board.
Yes, I think actually I really like what you said about this recipe, because for me that was kind of a pet peeve a little bit over years. I think there's too many of those recipes floating around there.
Yeah.
Too many of those kind of by like quick lines on trading, like losers keep average losers, whatever, winners run winners or whatever.
Yeah,
right?
yeah.
Keep your stops tight or whatever, and you'll sleep well at night. Whatever. Did I just
keep your stops tight and you'll get whipsawed to death, right?
Right, exactly. So there is no one way to approach markets. There are some wisdoms which I think I like. One of the, for example, wisdoms, and just to give an idea, always review your portfolio and think, if you didn't have any positions, if you start today from scratch, is it exactly the portfolio you would have built, right?
Yeah. I think there are principles.
Position because you have it, right?
Yeah, I do that often. I talk to people who just start out, and you're more diverse than just equities, but I tell people, I go, imagine how Warren Buffett felt about Fruit of the Loom during the pandemic, because the fact that it doesn't have a stock price attached to it, that it's just a business, often that helps me a lot. Is if I see a stock price doing something that is a little more volatile than I'd expected, I say, well, what if it didn't have a stock price? Would I be a proud owner to own this? And do I think people will still use this product 20 years from now? Will the sun come out and get a little longer time horizon? That's really helped me a lot. So I agree with you that maybe not recipes, but principles. And again, I'm very proud and excited to recommend the Trades of March 2020, a shield against uncertainty. I think that's, to your points you've made, very uncertain times, particularly with the Federal Reserve and the unprecedented fiscal and monetary policy that they've seen in the United States and also in Europe, the ECB and Central Bank of Japan. This is a global, I think the macro trade's the biggest trade right now to learn about, MMT, all these things. So you've been so gracious with your time. What would your parting words be for our audience? If someone's new and they're thinking about taking this on, what would your counsel be to the newbie?
I think you should just try to decide if your heart is in it. Is it like something that you're really passionate about doing, and try to understand, try to think through 3 points. Do you really love it? Do you really love financial markets? Can you cope with them psychologically? And what is the origin of your advantage in financial markets? What it is that you're going to do better than anyone else in the world? Think about those 3 questions.
It's such a good question to think about the process. I know Warren Buffett, they asked him when he decided to be an investor, he said he decided about 9 years old. And what's interesting is if people do this just for the money, they're not going to last. I know that sounds weird because that's why we do it, but Warren Buffett, he could have retired years ago, but he gets up in his 90s now, and he goes to Berkshire Hathaway, goes to his office because he just loves the game. He doesn't go for the money anymore. He goes for the thrill of being able to do it because he loves it. And I can tell, Alex, you're the same.
There's one thing I want to say about Warren Buffett, which is kind of a good parting comment. If you look at his annual return, there are traders who actually had better annual returns.
For sure.
Funds that had consistency. However, why is Warren Buffett more successful than others, or like why he has more money than others? There is only one key to that. He just stayed at it.
Yeah. And he's 90. He's been around long.
70 years
compounding.
If you stay at it for 70 years, if I am there 40 years from now, if I can keep going 40 years from now, like the way I've been going last 25 years, I could be as successful as Warren Buffett. No problem.
Compounding.
Will I be able to be at it for another 40 years?
Yeah,
right?
Compounding rewards longevity, doesn't it? That's a pretty easy formula. Alex, thank you so much for your time. Wonderful insights. I feel so lucky to be able to speak to people that have better experience than I am, play a bigger game, and are smarter. So again, your website is Honte Investments. It's HONTEINV.com. You can learn more there, and also pick up the Trades of March 2020, A Shield Against Uncertainty. Hope you enjoyed the conversation, and we'll see you next time.
You've been listening to the Cash Flow Academy podcast with Andy Tanner. For more information on investing made easy, go to thecashflowacademy.com.